Wilfred, do you think this Powell brainerd Fed, is that going to be good for markets? What's your outlook?
Hi, good morning, Yvonne. I think we had confirmation overnight, indeed, that Powell has job security now at the Fed. He's staying there. And market likes to, I think, interpret it as potentially a slightly more hawkish tilt by the Fed. We could see the taper happen a bit quicker and rate hikes possibly even penciled in the market. I think market's now pricing almost 3 rate hikes next year. It is, of course, going to be a little bit more challenging for overall liquidity, but let's remember that the system, the financial system globally, is full of liquidity, right? And inflation is a bit of a problem. And so we do need to see, I think, a bit more tightening by the global central banks, especially by the Fed in the year ahead. And it will be slightly challenging for financial markets, but it is, of course, a sign that the real economy is healing quite rapidly everywhere.
So the knee-jerk reaction was bond yields ticking higher, dollar ticking higher here, and the market just further moving up the chance of a full rate hike to as early as June right now. The fact that there's this removal of uncertainty, that we can move past this nomination phase now, allows the Fed to open up and be a little bit more aggressive and slightly more hawkish. You buy into that idea?
I think so. Again, we need a bit of go-ahead. The market just wanted to have some clarity of who would be in charge. And at the end of the day, I think the Fed is going to be very data dependent. Looking at what's happening in Europe right now with COVID, it is, of course, I think trying to take a lead from that as well. And global conditions, I think into the new year will be fairly interesting, given, of course, some potential slowdown in China.
Yeah, and I just want to talk a bit more about China now. It seems like when it comes to the high yield market, it's gone from fear, outright fear, to now almost greed. And you are seeing some managers out there that are looking at these bargains and saying, look, maybe we've seen the worst of it. Are you one of those, Wilfred? Do you think that we've seen a floor on Chinese high yield?
Yeah, I think so, indeed. We have been committed to the Chinese real estate sector, and even in this sell-off, we have seen tremendous buying opportunities. I think let's be realistic and realize that the challenges for Chinese real estate are still there. The developers do need to shape up or ship out, and by that, what I mean is that we are looking at maturities of about $3 billion in December alone, looking at another $9 billion coming due in the onshore and offshore market by developers in the first quarter of next year. And so time is ticking. The developers do need to play their part. They do need to continue to work out in a way. We are moving into Thanksgiving, into Christmas, and the market participants may be taking a slightly easier time off. But I think the developers have a lot of work to do going into year end to just be ready for the next set of maturities coming due.
Yeah, and we have seen signs of, I guess, easing when it comes to these property curbs, whether it's allowing some of these asset-backed securities. But there is some criticism that this is only going to help some of these higher-grade property developers out there. Does that mean that we're going to continue to see a very bifurcated market?
I think, to be fair, on some of the more stressed names, they have been playing their part. If I use the analogy of exercise, for instance, we have seen some of these companies lose weight. They are selling non-core assets. We have seen them continue to develop properties and to execute on them. They're training hard. If I think of how the chairmen themselves are pledging personal loans to ensure access to finance, they are showing commitment. And in that sense, the weaker names are trying to do their part. And if I were to think of the regulators themselves, as so-called fitness instructors during this period,